Gold had a good start today as a precious metal finally has been trying to string together some strength, and then it fell and face planted. Let's bring in Scott Bauer, CEO of Prosper Trading Academy, and talk about what's going on here. Scott, as we've got yields up today, it seems like it's shaking things up a little bit.
Oh yeah, and it's trading, lockstep with the dollar as well. So, just all you have to do is look what the dollar did and look what, as you just said, what yields did today, Oliver, to see what happened with the price of gold today. I mean, that's it. Just look at those charts. Look at that chart. Look at the rally this morning as, the dollar was relatively unchanged and bonds were rallying, yields were lower, and then, kind of midday here. So, why is that? What happened? Is it a risk off based on, geopolitical concerns here? Well, maybe for the dollar, that's why, the dollar caught a little bit of a bid and gold sold off pretty significantly.
So I guess the old macro relationships still hold in the case of gold. So if one's going to be trading it, I guess you have to have a pretty strong view on rates. So what do you think about this bounce we got waking the 10-year yield back up, Scott?
You know what? I have said, and you know this, and we've had this conversation for about 2 months now, that I believe the Fed is getting, is going to overshoot, and they are going to start pulling back, whether it's the end of this year, first quarter next year. That's kind of what the market was looking at, but then you got some of the Fed governors, Fed presidents coming out today saying, no, that's not the case. We still got to tame this inflation. But then you have some of them saying, now September, maybe we're going to go 50 in September. When, just a couple weeks ago, 75 in September was on the table. 50 was almost an absolute certainty. So, is it a matter of rates just ticking higher today because of the global environment, because of some geopolitical risk? Maybe it could be, but I really don't see how the Fed is going to be as aggressive as they have been. I know they've come on, they've taken the foot off the pedal a little bit here, but man, oh man, Oliver, the economic numbers that still keep coming in, they're not good. There's slowdown is here. It's been here. They're finally being reflected in a lot of numbers. And you know what? Look at the JOLTS number this morning. This is the first, a contraction of over 5%. That's one of the first signs also that we're seeing that maybe the labor market is slowing down a little as well.
And that's our golden child.
Yeah, exactly.
Powell's go-to. So
no about it.
We got jobless claims, Scott. I mean, at what point do we start to get worried? Not to make you play Fed chair, but when we try and figure out what moves the market, are we going to be shifting our kind of cues a little bit now that we got the big tech stuff, earnings done? Powell's kind of giving us the message. We've got Mester and Harker later this week, but it seems like maybe jobless claims and employment will kind of get back to the old classics.
Listen, it's going to be a really important number. The market's going to move on it. But unless we get a massive outlier one way or the other, I don't think it's going to impact, the performance or how the market reacts. The numbers that are expected, analysts are expecting a lower number than what we saw in June, a significantly lower number. I think this one's supposed to be 250,000. June was like around 350. So if we come somewhere, I'm going to say somewhere between 175 and 300, that's pretty much an as-is scenario to me. Now, if we get a massive, robust number that even eclipses what June was, well, you're going to see, yields go higher. You're going to see Fed probably get that very hawkish stance again. But then on the flip side, if we get a real negative number, not negative, but if we get a number that's, let's say, 100,000 or even 50,000, which I can't imagine that's going to be the case here, then all of a sudden it's going to be brakes are on. Brakes for the market, brakes maybe for the Fed is on. But I don't see that happening. I think, again, anywhere in a span of 150 to 300, that's going to be right in line. Market probably takes it in stride.
At what point, Scott, you're hinting at there, but to close it out, what point for the yield do you think it starts to blow back on stocks again? I mean, can we handle numbers we've already seen before? I don't know. It kind of looks like today that even if you start selling off from down at 2.6, market still is not a big fan.
No, it's not at all. And, there's still a psychological level. A three handle on the 10-year is a psychological level that will drive the market crazy. And all the bears are going to come flying back in here. That maybe reinforces the bear market rally that we've been into, but it's going to take a lot to get the 10-year back to 3%. So, I don't see that happening unless we get, maybe this number just so incredibly hot on Friday. And, given what we're seeing with the rest of the economy actually slowing down, the JOLTS number, I just don't see it happening.
Okay. All right. Good combo. Scott, good preview here for the second half of the week. All the economic data that's on the way. Appreciate it, Mr. Bauer.